Hello. Maybe shut the door before going live. Now, got a great session for you tonight. We're going to cover the second half of the weighted average cost of capital calculation. So we've covered in a previous live session the cost of equity. And the cost of equity takes into account, there's a couple of ways you can calculate the cost of equity. So I'll draw for you the cost of equity and give you a bit of a recap in terms of the cost of equity to a business and a bit more about gearing. And then I'm going to use this half of the board to do some drawing and things when I talk about the cost of debt coming up in a second. I'm Ian Smith. I'm TheStrategySmith. I'm a management consultant and business coach. So I'm going live on 5 platforms this evening: LinkedIn, TikTok, YouTube, X, and Facebook. Please like and comment on the platforms that you're watching. I always get back to all of the comments. I just might not see them live with me going live across 5 platforms. We're going live on YouTube as well, actually. I think I mentioned Facebook twice. So Facebook, YouTube, TikTok, X, and LinkedIn. So what we're going to look at now is just a recap on the cost of equity. Because the full equation I'll draw for you, the weighted average cost of capital equation, I'll draw for you, and I'll talk a little bit more about why it's a really good way of finding out how a business essentially ticks, how a business is geared, how it's operated, how it's financed, the operational decisions that you can make in a business that affects the weighted average cost of capital, what you can do in terms of your gearing, how the business is financed and leveraged in terms of solvency, how that can also affect the value when looking and incorporating tax as well when we look at cost of debt. So it's a very strategic way, not only to find out the weighted average cost of capital for a discount factor to discount forecasted future cash flows for a net present value of a business, but it's also a very good and strategic way of understanding exactly how the business ticks. And there's a number of different methods you can employ and a combination of such methods as well to give you different discount factors, different weighted average cost of capital results. And then you can apply those to your cash flow, to your project feasibility to understand net present value, calculate internal rate of return, and essentially give you a range of valuations as well, which is what you want. Understanding the range of values, why each value is what it is, why each discount factor is what it is, and how you can relate that then to the sector, to the business, etc., etc. It all comes from the weighted average cost of capital calculation. Once you've established a business plan for either it's a special purpose vehicle for project feasibility, or you've got a business plan for an exit, or a business plan or you've been given a business plan for someone you want to buy or essentially work with. When you take into account that business plan, you should always have 3 financial statements: profit and loss, balance sheet, and cash flow. And then looking at the business plan and the financial statements to work out the weighted average cost of capital gives you lots of understanding as to how the business ticks, how the business works. So cost of equity recap, we covered the capital asset pricing model. That looks at the risk-free rate. Well, I'll talk about the risk-free rate as well when we talk about cost of debt. Looks at the risk-free rate, so we'll call this risk-free rate RF. And the risk-free rate is the rate at which a government bond is issued. So essentially, if there is no or little risk to a security, then there's something called the risk-free rate that looks at what's the minimum risk that's allocated to that security, and it falls back to the premium that the government issue for releasing long-term bonds or a short-term treasury bill. And that's the closest thing we've got, because governments can create more cash, essentially. Now, one thing to take into account with the risk-free rate is, although that security is deemed to be risk-free, investors still want a return on that investment or take into account an element of risk. And so to understand the real rate of return should account for inflation there as well. Capital asset pricing model is the risk-free rate. We add that to the credit risk premium. The credit risk premium takes into account the fluctuation of the beta of the equity, which highlights how in sync the beta is with the market. So if the market is operating at an average of 1 above 0, and the beta is showing 0.5, then it's a lower fluctuation. It's a lower risk, but you'll get a lower return for your investment. If the equity beta is, we'll draw this down here. If the equity beta is showing to be at 2 above the market or above 0, then it's got a high fluctuation. So it's a higher risk. And therefore you need to account for that higher risk based on the shares that are financing the business as to how they fluctuate in comparison to the market. So because there's higher risk, there's higher reward and higher risk of loss as well. So we take into account the equity beta, and then we multiply that by the return on the market and estimated return on the market, and then we minus the risk-free rate. Cool. That's the capital asset pricing model, and it gives you a percentage to then multiply by the debt over debt plus equity. So then we looked at another method, which was the dividend valuation model. That's the Gordon growth model. So dividend valuation model, that looks at the dividend over the price and adding the growth. This takes into account the growth of the dividends that have been issued. It's more accurate the further in time you forecast it. If you can make it more complex and more accurate by adding in greater timescales and greater and variable values of growth for those timescales as well, if they're different, if they're differentiated. This is another, so we'll put or there. If you look at the other live, it shows you how, the two methods as to how to calculate those. Once you understand the cost of debt, we can multiply that by debt over debt plus equity. And that's the market value of short and long-term debt over debt plus shareholders' equity. And that will tell you how the business is geared or how it's leveraged. If it is financed by debt by 50%, then this will be 50% because it's what is financing the assets. So if you think of the balance sheet, the total assets needs to be equal or balanced with the debt plus shareholders' equity. And therefore, this amount of debt is financing the assets and therefore financing the operation of the organisation. So, although it's quite scruffy, I've drawn it neatly before, but I wanted to give you a recap of the cost of equity. Cost of equity. Yeah. Because I'm doing a live on cost of debt, not cost of equity. So basically cost of equity multiplied by equity over debt plus equity. And this takes into account the cost of equity. Then we look at the cost of debt, which we're going to cover right now, which is added to taking into account the corporate tax rate and then debt over debt plus equity. Cool. So that's a recap on the cost of equity and a little bit more about the gearing. I'm going to cover cost of debt right now, and I'm going to rub this off because I'm going to give you some more context as to why we account for tax when we look at valuations, and also some illustration as to how all of this can then play out. So, big thing with the cost of debt is that you can take into account the risk-free rate. Again, the nearest thing is a short-term treasury bill or a long-term bond. But even if an investment is risk-free, investors still require a reward for that investment. And so it's important to account for inflation, to compensate for the time preference, and to include an element for inflation that gives us the real rate of return. Now, if an investor is investing in something that is risk-free, or the nominal risk-free rate, which is, again, short-term treasury bill, long-term bond, plus inflation, then they should receive the risk-free rate of return. However, corporate debt is not risk-free, and therefore we need to add a credit risk premium to take into account the cost of debt for this entity, for this organization. Now, we need to add credit risk premium. Which is different from the equity premium that we looked at before, the equity risk premium that we looked at before. This is the credit risk premium. Now, as corporate debt is not risk-free, lenders and banks require more of a return for this credit risk. So if, for example, an investor is looking at a business, or a lender is going to lend some money to a business, this is where they take into account the credit risk premium in such a way that they'll look at their credit rating, which is something that is specialist agencies actually charge businesses for using their ratings against their credit. And they're publicly available credit ratings. We can get them for our own personal credit ratings. Businesses can get their own credit ratings as well. And this is known as the credit risk premium, in that the investors or lenders want more of a return for the risk that they're taking in addition to the risk-free rate because of the corporate debt, which is not risk-free. And so the way that you can work out the credit risk premium from the credit rating is that there's a debt premium for example, a AA+ rated entity. And so the way that you can compare the credit rating, publicly available credit rating, to the debt premium is by looking at the yield required for corporate bonds in general and compare that with a yield required for government bonds with the same maturity. So it's important to mention now geographies, because if your business is a UK entity, then you need to take into account the UK government bond. If you're in a large matrix organization with a HQ in the US or in Europe, in one of the countries in Europe, but you're looking to acquire a business in the UK or in Australia, then you have to take into account the weighted average cost of capital for that country, for that business that you're then buying. And so the credit risk premium will be different for businesses in different countries, because the government bonds will be different in different countries. And so, for example, if you were to take a business to understand the credit risk premium, if you think of a AA+ business or a AAA or A minus, for example, they will all have a comparison that you can make in terms of corporate bonds in general and compare them with government bonds with the same level of maturity. And they will give you a debt premium to add to the risk-free rate. So, for example, A minus be 0.99% or 1%. So these are basis points. The basis point is 1/100th of a percentage point, and debt premiums can be measured in basis points especially if they're lower than 1%. And so, for example, if we look at the risk-free rate, and it's quite a timely point to make with regards to rates in general, in that due to inflation or trying to dampen inflation, rates have gone up like 13 times in a row. I think like 5%, something like that, for the risk-free rate, which is quite high. And then the credit risk premium for specific business A minus, 1%. So that will give you the cost of debt of a total of 6% to factor into this calculation of weighted average cost of capital on the cost of debt side. And that's how one way of working out cost of debt, because looking at a business that has a low credit rating, then the debt premium will be higher, which means that the credit risk premium will be higher. And when we add this to the weighted average cost of capital, the discount factor will be higher. And therefore, when you discount that back on future forecasted cash flows, the valuation of the business in terms of its net present value will be lower. So that's why it's important to take into account the cost of debt, credit risk premium and risk-free rate. Now, there's another way we can calculate the cost of debt without needing to look at credit ratings or without trying to compare it to debt premiums. And you can do this through the balance sheet and also some notes in the financial statements as well. So we've got one way of calculating cost of debt. That's risk-free rate added to the credit risk premium. Or we can look at the cost of debt in its more literal form, or in terms of cost of borrowing. Now, the cost of borrowing is how much interest you're paying on annual average debt. So if a business is heavily leveraged by finance, by debt, how much interest are they then paying on that annual average debt? The reason why you take an annual average is you want to look at previous performance of the business. And in the balance sheet of previous years, you look at short and long-term debt and add them together, and you average them to a point of now when you look at this year's annual interest. And that will allow you to look at the cost of borrowing based on how much interest you're paying today and how much from previous borrowing you're costing the business in terms of borrowing money. So you look at the annual interest divided by annual average debt. That will give you the cost of borrowing. Now, that will also give you a percentage. And there's an option to use one of these calculations to then multiply by 1 plus the tax rate, the corporate tax rate, again, in the country of the business that you're looking at. So, for example, if you were to do business in the UK, the corporate tax rate may be higher than if you were to do business somewhere else in another country. And if the corporate tax rate is lower, then the cost of debt is a better risk, because it's a better way to do business, perhaps, in terms of investment. Because when you're looking at discount factors and taking into account the corporate tax rate, if it's lower, you're multiplying it by the cost of debt from one of these two calculations, which will again affect the discount factor. So the greater the discount factor, the greater perceived risk in terms of cost of debt and cost of equity. And therefore that is used to discount back forecasted cash flows to give you net present value of future cash flows. So now we've got two ways of calculating cost of debt. Now, cost of debt is very important. One thing that's important to mention now is tax, and why tax is incorporated in this calculation. And in the same sentence, mention gearing or leverage. So we've covered 4 areas of financial health in live sessions previously: liquidity, profitability, asset management, and in this case, solvency, how a business is financed by debt and equity. Now, I'm going to draw a table that looks at the P&L and highlights the difference between incorporating tax and gearing for a business, and some of the pros and cons for that as well. So I'm going to redraw this. I'm just going to move this back a bit. Right. Annual interest, annual average debt, and we'll draw this on this side. So let's say you've got company A, company B. Oops. Yeah. They're both identical in terms of EBIT. There could be 2 identical businesses, 2 subsidiaries of the same group, just as an example. But what's important to note is who gets paid first: the bank and then the tax people. And then looking at how the valuation of a business can be taken into account when one business has chosen to have debt on their balance sheet. So, for example, we'll look at company A and company B in the same way. We'll look at EBIT. So before EBIT, you've got sales, you've got cost of sales, then you've got gross profit, then you've got expenses that come off that, then you've got EBITDA, which is earnings before interest, tax, depreciation and amortization. Then you've got depreciation, then you've got EBIT. Earnings before interest, then tax. So after EBIT, the bank gets paid with interest. Okay. Then after interest, what's left gets taxed. So we've got profit before tax. Then you pay tax. Okay. Now, and then what's after that is profit after tax, which is what's left for the shareholders. But if we look at company A and company B, they've both got 10 million EBIT each. Now, company A has 0 debt. Let's just say they're 100% financed by equity. They're not paying any interest to the bank. 0 interest. Company B does have debt. It's financed, let's say, by 50% debt. So they're paying 2.5 in terms of interest. And that leaves us with profit before tax, 10, because they've paid no interest. And here, 7.5, because we've taken off the interest. Now we get some tax going on in the equation. So profit before tax, they're taxed of the 10 million. So they're going to pay 30%, let's just say, corporation tax. So they'll pay about 3 million. These guys paying 30%, they'll paying less tax. Now, when we look at the net interest that's going to debt holders, but then also look at the net dividend for shareholders and then the total for investors. Now, that's really important as to why one company is worth more than the other to investors. And you might be surprised as to which one that is. So if we look at the net debt, let's see if we've got a better pen. Net debt to lenders. Then we've got net interest to debt holders. Net interest to debt holders. Okay. Then we look at the net dividend for the shareholders. Then we can look at the total that's left for investors. All right. Okay. And we'll just make that a bit more sensible there. Cool. So the net interest to debt holders, in this case, for company A is 0. But to company B, it's 2.5. The net dividend to shareholders is 7. And the net dividend for company B is what's left over, 5.25. But the total for investors now is 7 for company A and 7.75 for company B. Now, why is it 7.75? So it's the total left for investors, and it's essentially 750 grand more in value because it's chosen to have debt on its balance sheet. Now, the way that works, the difference in the 2.5 is tax relief. So it's the true cost. The true cost of debt is not the gross interest paid, but it is the net interest paid after tax relief. So it's essentially a gift from the government. This business is worth 75 or 750 grand more because it's chosen to have debt on its balance sheet. Now, if company A chose to leverage, so these are the strategic decisions I was talking to you about. If they chose to leverage, then their total for investors would go up. If company B was to leverage higher, then their taxable income would be lower as well because they'd be paying more interest on that debt. And so these are the strategic decisions as to how to optimize gearing, and then thinking through line of sight, how that impacts balance sheet, how that impacts cost of debt, how it impacts if you're paying everything properly, the credit risk premium, how it impacts if you want to calculate it in this way, the annual interest over the annual average debt. But the biggest game changer for this is the tax. And that's why we need to take into account tax when we're calculating cost of debt, why we need to incorporate tax when we're looking at gearing, because gearing on its own doesn't necessarily affect the valuation of the business. only when we look at tax and how the business is financed. So that's why we look at tax. So once we've got the cost of, need to get some better pen, another pen. Once we've got the cost of debt, we then need to multiply that by 1 minus the tax rate. So we have cost of debt multiplied by 1 plus tax. All right. Then, once we've got to this stage, we multiply this by, we can rub that off now. Yeah. That's the second half of the weighted average cost of capital calculation. So now we understand the cost of debt in terms of the risk-free rate and the credit risk premium. We know how to calculate it through cost of borrowing, looking at the annual interest and the annual average debt of the business. We know we need to incorporate things like the country for tax rate, look at things like the credit risk premium and the bonds or the yields that are compared for the debt premiums, that they're in the same country of the business being valued. And there are different comparisons that you can use for different businesses as well, in terms of corporate bonds, to use comps when you're evaluating rates for debt premiums and things. So that's another great point as well, is that these calculations are as good as the information that you add into them. And you need to use your skill and knowledge and experience of using these calculations, and also your industry sector and business knowledge as well. And so for people in operational roles working with financial specialisms, hopefully this allows each areas to coordinate and align more efficiently, because I've been in those boardrooms where questions are asked that mean exactly the same thing, but they're just asked in a different way, almost a different language, because one's finance, one's engineering, one's HR. They all, then the CEO is asking the same question, but in a different way. The answer nearly always gets to a singular common point. But the questions, sometimes in the way that they're asked and answered, mean the same thing. They're just answered differently and asked in a different way, because people think differently when they're close to things. So that's why another reason why I wanted to approach the weighted average cost of capital calculation, is just to get a little bit more of that language across. So let's put it all together now, because there's the cost of debt, but there's also the cost of equity. So once this is added on here, we add that to the cost of equity, and I'll draw the calculation in a second. Cost of equity, whoops. And that's multiplied by equity over debt plus equity. So I'm going to draw it a bit neater for you now, because we've focused on cost of debt. So we'll clean the board down, we'll draw the WACC calculation, and then that will be the whole WACC calculation. That's your WACC. So when I draw the WACC calculation, I'm going to talk to you a little bit about some of the things that you can think of strategically in your business, so you can understand a little bit more around discount factors, how people would look at your business in terms of valuation and things like that. So WACC, I've seen it drawn as a K or an R it's essential that it's consistent throughout, but WACC is the discount factor or required rate that you can add to a business to demonstrate the level of risk if you're investing into it, because you've taken into account the credit risk and you've taken into account the equity risk in terms of cost of equity and cost of debt. You've looked at the tax rate and also the gearing. For argument's sake, I'm just going to use the letter R, and we're going to call the WACC RO. So RO equals the WACC. To get to RO, we need to take into account the gearing, and then we need to multiply that by the cost of debt. The cost of debt we're going to call RD. That's multiplied by 1 plus the tax rate. Then we're going to add this to the cost of equity. We're going to call that RE. That is the WACC calculation. So RO equals WACC, as I've mentioned. D equals debt. E equals equity. RD, cost of debt. RE, cost of equity. T equals a tax rate. So if you were to play this out, if you were generating funding requirement for project feasibility, just as an example, understanding how that is financed and everything else, you will create your own weighted average cost of capital as a discount factor, because it will be a special purpose vehicle. It'll have it'll be almost a going concern. You'll forecast feasibility over 30 years if you're constructing something large, and that's the kind of acceptable length of time for the life of the asset, or you can forecast further. But looking at how it will be geared will be taken into account quite heavily so when the bank lends money, and they'll want to see progress before they release more money and things like that. Where this comes into kind of to make it real is when the discount factor is calculated in that way, you establish what's called the internal rate of return. So when you get the discount factor, let's say for this example, it's 10%. Based on the forecasted future cash flows, you will need to discount back each year, maybe years 5 to 0, discount them back by 10%. And if you get a whole number, then that will be the net present value. So let's say the net present value is 101, just as an example. Now, the internal rate of return has a net present value of 0. And what that means is how big does that discount factor need to be to get this 101 down to 0? And that presents a marginal understanding as to how much of a discount factor needs to be applied before the project loses money. And so, for example, some banks would only look at investing it if there's an internal rate of return of like 40% or 50% even, which means that the discount factor needs to be 50% to get the net present value of the business plan down to 0. So that's a hell of a risk. If you think of getting to 10% of the looking at the cost of debt and the cost of borrowing, looking at the credit risk premiums, if that's something that you're looking at, looking at the cost of equity or the dividend valuation model, how high those need to be in order to get a discount factor of 40%. So that's how much risk sometimes investments are taken into account for, is if there's a discount factor of 10 to 12%, how high can that be in terms of the risk associated with the weighted average cost of capital before the business or the investment loses money? And that's where net present value and internal rate of return come into play. That's your WACC. That's the weighted average cost of capital, cost of debt. You can look at this and make some strategic decisions about your business. You can hopefully communicate much better with corporate finance guys, and vice versa. And by all means, comment and ask questions about this, because it's a collaborative forum for us all to learn and use what we're showing here. And that's your WACC. So I will see you all next time. I'm going to cover some project management stuff. I'm going to continue with the finance theme, and I'm also going to continue with the strategy and growth themes as well. So I'll see you on the next session.